Hi, thanks for joining us. I'm Kerri Allen. I'm a senior client advisor here at TFC, and I have also a certified financial planner designation and enrolled agent designation.
And I'm Toni Grimm. I'm also a senior client advisor at TFC. I'm also a certified financial planner and a certified divorce financial analyst. So some of you I know and work with, and I appreciate you coming. Some of you I don't, and welcome. We're really happy to have you here.
Yeah, so we're excited to walk you through some of the top planning and investing tips that we typically share with some of our younger clients. So I will just jump right in. Starting first with the topic of saving and investing. So this is an interesting one. I'll speak first to the topic of compound interest. So compound interest is like making your money work for you. And it's not just interest on what you originally put in, it's also interest on the interest that's already been
It's
added.
like double interest.
Right. So, and the earlier you start with saving or investing, the better, and the more time your money really has to grow. So I like to say that even small investments over time can really add up to a lot. And life is also full of surprises, and that's where things like having an emergency fund can really become a big deal to make sure that you're not running up any unnecessary debt. And we typically like to aim to have somewhere between 3 to 6 months worth of expenses saved and put aside. If you can't save that much right away, just start slowly, let it build up over time.
Mhm.
And, another interesting thing, so many of you will have employer retirement plans that have a match. Anytime you see that, contribute at least as much into the 401k to get that match, more if possible. But that match is like free money.
Yeah.
So definitely take advantage of it.
And it's not a bad idea as you get, merit raises or cost of living
Right.
raises to incrementally increase the contribution to your retirement plan along with it.
Yeah. And so really just starting to build those good financial habits, the sooner the better. Tracking spending, setting goals, all of those things become really important for down the road. And next, I want to take you through uh, a chart, and this is an interesting description, really, of the performance of 10,000 in the S&P 500 over the last 20 years. So, so on the left-hand side of this chart, we show that that same 10,000 over that 20-year period, if you just had stayed fully invested, has grown to almost 72,000 or a 10.4%. On the other side of the screen, the far bar on the right, if you had been out of the market for just 60 of the best performing days, that 10,000 is now only 4,700 or a negative return of 3.7%.
So that's 60 days in 20 years.
Yeah,
That's remarkable.
it's significant.
Uh-huh.
And so you can see everywhere in between where you would have landed by missing, 10 days, 20 days, 30 days. But I think the point of it is that, because those best and worst days in the market are often clustered super close together, you
Hmm.
just can't try to time, when to get out and when to get in, which is hard to do, right? Because like losses are very emotional and
Right.
sometimes make you want to sell out and go into cash, but try to avoid that at all costs because it's just too hard to know when to get back in.
And nothing's proved that more than the last 3 weeks and the volatility that we've seen. An important part of saving investing, as Carrie talked about, is also about establishing goals, like buying a house. So that tends to be, one of the questions that we get a lot from, some of our younger clients is how much can I afford? What should I put down and what should I mortgage? So a great place to start with that question is just understanding your monthly expenses. We can't say it enough that knowledge is power. be informed. There are so many great apps out there where you can use them to track your expenses. Figure out the discretionary and non-discretionary expenses. And like Kerri said, savings should also always fall into non-discretionary, meaning that's an essential expense.
Right.
And
Pay
once
yourself first.
pay yourself first, exactly. And once you understand your expenses, then you can also use online calculators to run different scenarios of down payments and mortgages. Call us to help you. We'll do that for you as well. We've got a lot of, great tools at our fingertips, to help you weigh through the different interest rates and, how that's going to affect you. And then we have to add in the cost of actual home ownership, particularly if you're going to be moving from the city to the suburbs, you're going to have expenses that you've never had before, like landscaping, for example. And then, of course, there's the standard expenses with home ownership that sometimes come as a little bit of a shock, like expenses, like real estate taxes and insurance. And so, while you might be tempted to put as much down as possible to reduce the size of your loan, don't forget that the interest you pay on your loan is tax deductible. So that's a consideration, but it's also really important through the home buying process that you maintain your emergency funds savings. Where would you find $20,000 to put on a new roof?
We
For
just went
example,
through that.
you did. I know, right?
Yeah,
Yeah,
it's
and
a real thing.
it's a real thing. Yeah. So where would you find that? You have to replace the heating, cooling systems, make sure you maintain those emergency funds. The other thing to consider is just picking the right loan vehicle for you. So, if you're buying a starter home and you say, we're just starting out, we know this is going to be 3 to 5 years, and then, as our family grows, we're going to do something different. Maybe a 30-year mortgage isn't the right choice for you. Maybe you go into an interest-only arm. Maybe you do 7 years, maybe you do 10 years. Maybe there's so many choices. So I also recommend that you lean on your mortgage broker to lay out what your options are. And then,
And certainly something we could help
of course,
run the
yeah.
numbers
And then
for.
we run the numbers. You look at what the loan options are, and then we run the numbers for you, and we'll help you get there. So it's, the other thing that, we're hearing all the time about home buying is just, well, now is not the right time, or is now the right time. Interest rates are so high, housing prices are so high. So, we pulled this chart just to, again, inform you. This is half of what our job is to, help you become more informed. So the blue line on here tracks mortgage rates. Over the last, 50 years. And you can see we're actually right now, yes, mortgage rates are higher than they've been in 10 years, but they're actually at a long-term average. And, we do think mortgage rates will come down a little bit, but they won't come down to where they were, 4 years ago. We will probably not see those types of rates again in our lifetime.
Which is, it's too bad.
It's too bad, but you know what? If you did get a rate at that point in time, just consider it was like free money. You locked it in. That was great. But however, the green shaded area just highlights housing prices. So you see, housing prices continue to go up, and just like the investment markets, we can't predict what the housing market is going to do either, or what mortgage rates are going to do. But we can look at the long-term historical data and say, yes, mortgage rates are closer to a long-term average, and housing prices just continue to go up. So if you're waiting for them to come down, it could be a fool's errand.
Might keep waiting.
Yeah. And then you have a great
Yeah.
line about
Yeah, you buy the house, but you rent the rate. Once we see mortgage rates dip by about 0.5%, that's typically a good time to look into refinancing.
Yep.
So rates are just temporary.
yeah, great point. All right, so now we're going to get into some of the fun stuff, at least
All
fun for
right.
us, fun for Kerri and I. We're going to start talking about taxes and retirement savings. So,
Yeah, so let me share this next topic on the screen here. So, wanted to talk about, we get this question a lot. Should I be funding my pre-tax 401k or Roth? Why does it matter? What's the difference? So, with a pre-tax 401k, you're basically making contributions that lower your taxable income now, and that means you pay less in taxes today. The downside is that, of course, when you go to take distributions in retirement, it's fully taxable at ordinary income tax rates. It can be helpful though when, for example, if you've bought a home and you're just trying to save as much as possible, because it does result in more take-home pay now. Another thing to kind of keep in mind is that you'll eventually have to take those required minimum distributions at age 75. So a Roth 401k, on the other hand, is where contributions are made with after-tax money. So that means you don't get an immediate tax break today, but the benefit is all of those contributions and earnings are going to grow tax-free over your lifetime, and that can grow to quite a significant amount by
yeah.
retirement, and you can pull all of that out tax-free in retirement. So it's pretty cool. And I think, so where kind of the gray area can be in pre-tax versus Roth contributions, one of the things that we like to make sure of is that you're first contributing enough to the retirement plan. And then beyond that, we want to solve for, should it be pre-tax versus Roth, maybe some combination if cash flow is a consideration. So I'll take you through this next slide here, just to take a look at the what this looks like graphically. This is kind of interesting to see how this is broken out. So the blue shaded area on the bottom of this chart is basically showing that for younger workers or workers that have a lower income, it could make sense to be doing all Roth contributions. Then in the middle option where it says either or both, that's maybe some combination of Roth and pre-tax. So depending on your tax rate. But you'll notice as your age and income increase, the very top part of the slide, that's where it can make sense to be doing all pre-tax contributions. I will say, as a general rule, really early in your career, Roth kind of makes the most sense
Mhm.
when you're not making as much money. But the exception to that rule is always going to be if wealth is very concentrated in pre-tax assets, because, you lose some of that flexibility when you have too much in pre-tax, because
Right.
all of that has to come out at some point in retirement, and then it's taxed at ordinary
Yeah.
income tax rates.
At some
So
point, Uncle Sam is gonna, take
that's
his
right.
pound of flesh out of those retirement savings. So,
That's right.
and when you talk about, let's also remember too, when we're talking about those pre-tax versus post-tax, is just it's a good idea when you think about your retirement savings to every few years check your beneficiaries. So
Mm,
for some of you who may have been recently married, but you've been at your current job for 7 years. The beneficiary in your retirement plan, it could be
yeah.
your parents, it could be a sibling, it could be somebody that you just didn't intend. So, generally speaking, once you're married, you want to consider naming your
Yeah.
spouse as the primary beneficiary on your retirement plan. So it's always a good idea just to check those out.
Yeah. Great
Yeah.
point.
Yeah.
Yeah. Great point.
All right, so I'm gonna take it from here and talk a little bit about backdoor Roths. So this is when it starts to get really exciting for Kerri and I.
We do like this
We
topic.
do like this topic, yes. So Roth savings can be a great advantage when you're young. So in a, if in addition to your workplace retirement plan, you also have the ability to make additional savings. You might want to consider contributing to a Roth. Now, the caveat to that is that your Roth eligibility, for a couple who's married filing jointly, is you're going to lose the ability to contribute to a Roth once you're earning over about 230,000. This is where the strategy comes into play called a backdoor Roth. And don't let the name fool you. This is a legitimate strategy for retirement savings. So if you don't have an existing IRA balance, you can make an after-tax contribution to your IRA. So you're contributing to a 401k. That means the contribution to your IRA is after tax. Because it's after tax, you can automatically do a Roth conversion. You can right away go ahead and do a Roth conversion, and you don't pay any taxes on it because it's after tax money and the taxes have already been paid. And then you get that money into the Roth through, a quote unquote back door.
So that's a great way to be able to have additional savings over and above for what you're saving in the 401k, or if there is no 401k,
Yep.
to get that into a Roth vehicle.
Absolutely. Yeah. Now, if you have an existing IRA balance, this strategy might not work for you, but this is where I say, discuss it with your financial advisor because, they can walk you through other ways to make this work. But if you have like an existing or a legacy 401k, it does not factor into the backdoor Roth strategy, and you can still do that.
And so a legacy 401k, how does that work?
So a legacy 401k, that's what we call them. But a legacy 401k is going to be the 401k at your prior employer. It's a plan that you left behind. Now, studies show that individuals currently in their 20s and 30s are likely to have 5 to 10 jobs before age 35. Now, that's a lot of legacy 401k plans.
Yeah.
It's a lot of plans. And we know, because I know I've worked with some of you to roll these over already. So that's a lot of like plans kind of hanging out there in the wind. So the question is, what do you do with your 401k? And since I'm talking about backdoor Roth conversions, I am going to focus on what do you do with your 401k to preserve the ability to do a backdoor Roth contribution. And so, as with any situation, everybody's is unique, and speak with your financial advisor. But here are sort of three strategies to consider. So the first is, if you have a Roth 401k, that's very simple. You just roll it into a Roth 401k and you can do your backdoor Roth contribution. So that's easy. If you have a traditional 401k, you might want to consider doing a Roth conversion instead of rolling it into an IRA. Now, this is all going to depend on if you're in a lower tax bracket, if the size of the conversion seems manageable, if you can handle the taxes in that year, you're going to and you can do that conversion. Then going forward, you can still do the backdoor Roth contribution. If the amount of the conversion is sizable, you don't want to do it all in one year. You don't have to. You can leave it in the 401k. You can do it over a couple years, or you can roll it into the IRA and convert that over a couple of years. Just keep in mind, you're not going to start the backdoor Roth strategy unless you have zero money in a rollover IRA.
Yeah, that makes sense.
Yeah. But the third option, which it could be a viable option too, if you have a sizable 401k and you really don't want to pay the taxes, it's just not the right time. You can take your 401k and potentially roll it into your new 401k. So many plans will allow for this. So, check with your current employer and see if you can roll the traditional funds in your legacy 401k into your new 401k with your current employer. And so that's, just check the plan rules and, lean on your advisor to kind of help walk you through what the best scenario is for you.
Yeah, that definitely makes sense. So let's talk briefly about a couple of just kind of more basic
Sure.
planning needs
Basic planning, much less
that we would
complicated. Yeah.
recommend. So it's just a few of the easier topics. So um a healthcare proxy, you may have heard of this in conjunction with getting kind of your estate documents in place. What is it? It's really something, it's a legal document that gives someone else the authority to make medical decisions on your behalf. So it's just a good idea to have in place, especially if you want someone that's going to be able to make those decisions for you if you can't. So really good idea, very simple document to have, and we would recommend that.
The other piece that's important to put in place is liability insurance. So, this can be called excess liability, it's called umbrella insurance, it's got a couple different names, but essentially what this is, it falls under the property and casualty insurance. So, and the purpose of it is to provide exactly that excess coverage when a claim falls above your auto, renters, or homeowners insurance. So this is coverage that would protect your assets should you get sued. And so the question is, who needs umbrella liability? This is a great little chart that kind of walks you through basically everybody. If you have something to protect, then you need umbrella liability. It's not expensive. You can, just contact your insurance broker and, add it right on to your either your renter's policy or your homeowners. And it's a great sleep at night, just easy fix to put in place.
Hmm. Yeah.
All right. Now, building credit. So, when you're young, it's very important to start to build credit. You're going to need it later on in life. And, one of the great ways to build credit is with a credit card. So we get this question all the time. I need to get a credit card. What credit card is right for me? We want to make sure that you are, number one, paying off your credit card monthly. And, number two, probably don't get involved in a credit card that's going to charge you an annual fee unless the benefits are really worth it. And again, like we've said over and over again, do your research, find out what are the benefits that come with a card. And, a trick, actually, Kerri told me about this trick. In terms of building credit, which is to pay off your credit card a few days before the statement comes due.
Yeah, it can really make a big difference if you're trying to get that credit score up because it looks like you don't have any balance. And really, I think to Tony's point, just paying off your cards in full every month,
Mm-hmm.
you just have to do that.
Yeah.
That interest rate is way too high.
It's way too high. Yeah. So then when you look at the benefits that different cards will give you, there are, airline cards will give you a free checked bag.
Mhm.
I have 4 kids. Flying with them is very expensive. Those free checked bags are real money. So, I like the airline cards. There are also cards that'll give you cash back. You can get cash back into a retirement account. You can get cash back into a 529, so just look at your options, do your research, find something that makes sense in your life, and just the cardinal rule is paid off every month.
Yeah. So I think we're going to wrap up with this topic.
The value of a financial advisor. Well, we think we're valuable. We think we're worthy, but several studies have been done to try to actually quantify the value of a financial advisor. Some well-known companies like Vanguard and Morningstar, companies you might not know as well, like in Investnet, have gone through extensive studies, and they've sort of assigned a basis point in terms of where they think the value lies. And interestingly enough, Vanguard weighs most heavily behavioral coaching. We like to think of this as sort of missteps avoided, right?
Mm, Yeah, you don't know what you don't know sometimes, right?
Hmm.
It's helping to avoid those costly mistakes.
Yep. Yeah. And so, we really pride ourselves on partnering with our clients. We want you to understand what we're doing, when we're doing it, and why we're doing it. It's important to us that you become an engaged part of the process. There's nothing that, Carrie and I enjoy more than this nerdy stuff. And when our clients really want to dig into the weeds on it with us. So, please don't hesitate to ever reach out and ask us any questions. And then the last thing we want to talk about, we feel like we would be remiss if we didn't bring up market volatility. So
Mm.
if you've been in, a meeting with either one of us in the last 6 months, you've probably seen this slide, but I'll just take you through it quickly. So this slide takes us back over the last 45 years and looks at the performance of the S&P 500. The gray bars show us where the S&P 500 finished that year, and the red dot marks the intra-year decline. And so you can see almost every single year there is a intra-year decline, and this just speaks to market volatility. And this is just a reminder that down markets are healthy
Mhm.
for they're part of a natural market cycle, and they're also healthy for the economy.
Yeah, and I think it's interesting to note that in this chart, the intra-year drops on average are about 14%, which is not insignificant. But over the last 34 of 45 years, returns annually were positive. So it speaks to, I think, the long-term trajectory of the stock market and the importance of just staying invested and trying not to get too emotional when there are those dips or even corrections in the market, which just happen.
Yeah, and
It's,
keeping an eye on your time horizon. That's really the most important thing, is what is your time horizon? And
yeah,
for most of you, it's going to be a very long-term time horizon.
yeah.
You might have short-term goals of buying a house or something like that we mentioned, and that you can
Hmm.
address that with your financial advisor. But when you think about your retirement in particular, that is going to be a very long-term time horizon.
Yeah, yeah.
Yeah.
That's a really
So,
good point.
well, thank you
So,
so much for joining us today, Carrie.
yeah.
Thank you. This was a lot of fun. We had
This
fun.
was fun. Yes. And feel free to reach out if there's any questions or follow-up items you have. We're happy to elaborate more on any of these topics or whatever your needs might be. So we'll talk to you soon.
Thank you.